Welcome to this round table of on the Stability and Growth Pact. And a special welcome for Mr. Sander Toudoir from the Center of European Reform from Germany, and Heer Lorenzo Cordogna, College of Europe and the London School of Economics from Italy, and Ms. Kit Young from Fit Rating from Spain, and Heer Oliver Kemla from Moody Ratings from France. Welcome all. On my left hand, the members of the Parliament, which are mevrouw de Vries, Heer de Vree, Heer de Lee and Itzinga, and they are from respectively VVD, Party of Freedom, GroenLinks, PvdA, I don't know in English, and the NSC.
The Green Labour Party.
Green Labour Party, yes, yes. These experts on my right side have been invited to comment the amendments of the Parliament on the national plans of some European member states and their assessments by the European Commission. I will give them the floor in turn, after which the members of the Parliament can ask questions. And I will start with the first on my side, it's Sander Toudoir. Your turn to speak.
Thank you so much. Thanks for inviting me. There is no German fiscal structural plan, because you might know that we have some trouble. I'm actually Dutch originally, so I'm honored to be here in the heart of our democracy. You know, there are many problems in Germany. Public investment, it came up in the prior session, is certainly one. I had a 4-hour delay yesterday on my train, so I had a great run-in, which I think illustrates one of my key points today. And essentially, I wanted to talk a bit more about the German economy, given that we don't have a sort of concrete plan to discuss, and maybe give you a metaphor, I think, where Germany is. And, you know, there is really a fire, a containable fire, but a fire in the German economy. Things are not going well, and that fire needs to be extinguished with water. And Germany happens to have a lot of fiscal space, and so it has the water to put out the fire. And that requires pulling certain levers, notably reforming the constitutional debt brake, which is more strict than the Stability and Growth Pact. And in a sense, there's a kind of waterfall. So if you do that, then how much space is there left under the SGP? So I'm going to talk about the fire, how we put it out, and then the sort of the waterfall, in good Dutch tradition, a water reference, how to do that. And so let me start with the economic situation. It's very, very clear now that Germany is stuck in a rut. There was a recession last year. There's probably another recession this year, not a deep recession, but essentially, if you look at the German economy since 2018, the last year of solid growth, we are in a situation of stagnation. And the total shortfall of the pre-pandemic growth path to where we are today is more than 5% of GDP. I mean, that's the same size as sort of the Brexit shock for the UK. It's very big. During the 2010s, Germany was, of course, one of the growth engines of Europe. And that was underpinned by very strong demand from particularly China and the US for the things Germany is good at: cars, chemicals, machines. And those still make up 40% of German exports, equivalent to 15% of German GDP. And that matters fiscally because chemicals alone provide 10 billion a year in net tax revenue for the German state coffers. Now, that model, you've maybe heard this metaphor from Constance Stelzenmüller, a colleague over in the US at Brookings. That model relied on demand from China, energy from Russia, and safety from the US, and all three pillars are shaking. You know, if you just look at energy prices, this is a story that certainly this country has also been through. So maybe I say a few more words on China. China is essentially pushing German exports out of its market. German exports to China have already decreased as a percentage of German GDP by 0.7%, significant decrease. And China's exports in Germany's key sectors are now booming because China doesn't like domestic demand and it's trying to grow its way out of its property problems. So just take cars, Germany's most important sector. China's car exports have six-folded in the last 4 years, from 1 million a year to 6 million a year. Germany at its peak was doing 4.5 million a year. So there's a massive China shock hurting the German economy. And then there are Trump's tariffs looming. And so the bottom line on the economy is the external environment, the global market, is not going to save Germany this time. There's another problem, which brings me to my second point, which is that things at home have been a bit neglected. So the debt brake, which is limits net debt issuance at 0.35%, not 3%, 0.35% of German GDP, has helped to keep German debt low, but it's also translated into very low public investment. So the public investment ratio of Germany has consistently lagged the OECD and EU averages. From 2000 to 2022, public investment in Germany was 2.2% of GDP, compared to an EU average of 3.2%, and something closer to 4% in some of the other G7 countries. And so essentially, to put it simply, bridges, roads, schools have been deteriorating more rapidly than that we've been rebuilding them. And this is also the case in critical areas such as digitalization, which really matter for the future. Compared to this country, for example, education spending, inflation adjusted, has gone up much more than Germany. And so the cumulative gap is now estimated to be 600 billion. 600 billion. There are different estimates, but that's the order of magnitude we're talking about. Germany still has strengths. It's very good at exporting machines still, also machines that matter for the green transition. It's still very good at R&D. It has leading research institutions. And it has all this fiscal space. And that brings me a bit to one of the key points before I go to the water issue, is, potential growth is low now in Germany. It's collapsed from 2 to 0.2%, according to the German Council of Economic Experts. That to me seems implausible. It is clear that German growth has declined given the structural problems it has. But I think that a fiscal impulse focused on public investment will also bring up potential growth in Germany, which in turn would give more space under the SGP. Talk about the waterfall. We have this 600 billion gap. How do we close it? There's now a widespread consensus in Germany that the 0.35% limit, the constitutional debt brake, needs to be reformed. Essentially, all the major policy institutions have endorsed a reform of one form or another, including the Bundesbank. And the precise shape of the reform is up for debate still. And if you could think that together with the SGP, so we have the debt brake, it's the most strict. Then there's the debt sustainability analysis under the SGP, which is probably the second most strict, actually, for Germany, given this low potential growth. Then the debt and deficit resilience safeguards. And then finally, the markets, which I think are the least strict. They're actually waiting for Germany to do a big public investment push. I don't think the financial markets are concerned one bit. And so how much space is there? The deficit resilience safeguard says 1.5. Again, the debt brake 0.35. The gap between the two is about 40 billion. 20 billion of that is military spending, scheduled until 2028. That's Germany's special fund for the Bundeswehr. And so that leaves 20 billion, give or take, of space. That's not really enough, right? So we think that public investment should go from 120 to 160. That leaves a gap of 20. And then comes in the new SGP. Mr. Verwey was just explaining it. I think if Germany submits a fiscal structural plan that has reforms on the labor market, on pensions, on some of the key issues that have long sort of plagued the German economy, combined with public investment, there are very good odds that they can get a 7-year path instead of 4. There are also very good odds, given the SGP's carve-outs for defense, that some of the defense spending could be left to the side and that Germany would get even a little bit more space to do the necessary public investment push. And so maybe I stop there and hope that the German election in the next year will give a sort of debate on this that allows that kind of reform. Thank you.
Thank you. And before we go to the next speaker, Herr Codogno, we will start at the presentation. So please. Yes, we will start to take a moment before I give. We go to the Herr Codogno. It wasn't it was already on the screen, but it was to see for the people at home only the screen and not the speaker. So that's why we switched it off. Yes, there we are.
Do you have a pointer?
Yeah.
Yes.
Okay.
Okay. So thank you very much. It's a privilege and a pleasure for me to be here. I won't touch on the fiscal framework again, because I think Martens did already a good job in presenting, outlining the whole situation. So my outline is pretty simple. I will just touch on what is relevant for the fiscal framework in the case of Italy. Secondly, I will discuss two big elephants in the room, which might actually affect the fiscal projections and the economy over the near term. And then I will look at economic growth, and then the revenue side and the expenditure side. And I'll hope to keep within my 10 minutes. So first of all, what is really relevant for Italy of the new framework? Well, as you can see here, first of all, the new framework is not less complex than the previous one. Actually, to some extent, is more complex. Okay. Now, in my view, it's easier to communicate, because at the end of the day, there's one single point that is really crucial, which is debt sustainability. But as you can understand, that debt sustainability analysis is much more complex and requires a lot more variables. So I think the new framework is backed by much more sound principles, and that is a good thing for Italy, and to kind of set the long-term trajectory in a proper way. It is realistic and gradual in terms of the required technical adjustment, fiscal adjustment, because if it's not realistic, then it doesn't count. Okay, so you really need to have something that is ambitious, but at the same time realistic. And I think the new framework did a good job in addressing that. By the way, as you know, the safeguard, which means 1 percentage point adjustment in the debt ratio, is not immediately activated in the case of Italy, because, as Martens explained, Italy is in excessive deficit procedure. And while in excessive deficit procedure, there's only one reference value that counts, so it's a net expenditure benchmark that is really binding. The other point that is quite interesting for Italy, Italy doesn't have a long-term tradition, as in the Netherlands, for long-term projections on public finance. There is the budgetary office that is attached to Parliament, but it doesn't do exactly the same function as here, the separate office that do projections. So it's good, in my view, that the new fiscal framework brings together the long-term budgetary and demographic trends with the short-term developments. So I think that is particularly good for Italy. Moreover, I think the new framework puts together investment activity and public investment together with fiscal, which is, again, absolutely essential in the case of Italy. So long-term planning is indeed a big plus. And also, I think there are some technical issues that I won't go into the details, but effectively the baseline projections are now much more reliable than in the past. I think over time some harmonization issues will be addressed. So overall, despite has been heavily criticized in many aspects, the new framework, I think it's a substantial improvement relative to the previous situation, especially on the things that are particularly touchy in Italy in terms of maintaining fiscal sustainability in the future. So let me go very quickly here. What are the two elephants in the room? The first elephant, of course, is the Next Generation EU Recovery and Resilience Facility. It's a lot of money. Okay, Italy is the main beneficiary of the European money in terms of absolute amount of money. Okay, there are many other countries that have received a lot more in terms of their percentage of GDP, but in terms of size, Italy is the big one. You can see from this graph here that a lot seems to be additive. Okay, in other words, investment projects that would not have happened without EU money, which means this is the kind of add-on on GDP. Now, the problem is that so far, Italy has done a very good job in getting the money from the EU, but not equally good job in spending the money, okay? And of course, spending the money is what really counts for GDP, okay? So far, I think the impact on next generation EU money has a bit disappointed. Then I will discuss why, but there are many reasons why that could be the case. The first reason is that it's not fully additive. So basically, it's not really new money invested, okay? Effectively, it's replacing investment activity, public investment activity that would have happened anyway. And the second reason is that it is squeezing out private money. Effectively, there is a limited capacity in the economy, so you cannot do infrastructure investment and then at the same time do everything else, okay? Because there is a limited capacity in terms of construction activity and other issues. So these are the two main issues, main problems. By the way, Italy introduced also another big scheme during the pandemic, which is the so-called super bonus 110%. I don't know if you have heard about it, but it's basically a very general scheme to renovate in an energy efficient fashion houses, residential houses, and the scheme is massive, meaning that it started very slowly, but just picked up. It reached something like 120 billion. And if you add also all the other schemes, we are getting close to 10% of GDP. It's massive, okay? And obviously, that is actually impinging on public finances. Again, the same two problems. First of all, you don't know exactly whether this kind of activity would have happened anyway without the subsidies, okay? Secondly, you don't know how much of the rest of the activity in the economy is squeezed out because of the scheme. And so it's extremely difficult to estimate what is the actual impact on GDP by the two schemes. However, we know the impact on public accounts. And this is the impact of the super bonus. So basically, it was fully recorded into the deficit figures because of the ruling of statistical offices. But it's yet to produce its impact on the cash basis deficit, because that is done only when the tax credits are offsetting the tax payments. So roughly speaking, it is estimated that will count about 2 percentage points of GDP over the next 2-3 years, okay, which is, again, quite significant. So again, on the deficit has already been recorded. And that's why Italy deficit is going down from 7.2% to about 3.8% in 2024, okay? 3.8% is quite a big jump, okay? And, but, again, on a cash basis, the impact is still to be recorded. So, bottom line, in terms of growth, you see Italy has suffered tremendously from past crises. You see the global financial crisis, the sovereign debt crisis in Europe, and every time suffer in terms of level of GDP and also in terms of pace of growth. This time around, it's pretty good, okay, the reaction. In other words, there was a nice rebound. Basically, Italy's GDP has recovered the same pace of growth that was recorded before the crisis, despite not only COVID, but also the energy shock. Let me remind you that Italy has the second manufacturer in Europe and is pretty much exposed to Russian gas, okay? So probably second only to Germany. So again, nice behavior. And again, now you wonder how much the two factors that I mentioned are important for that. And you might say, okay, they disappointed in terms of overall economic impact, but if they were indeed very important, you would be even more disappointed, because it means that much of the performance that we have seen is really related to a demand stimulus, which might well disappear in the future. Okay, that's... Now, let me give you also some good news. The good news is that public investment has recovered quite a lot. And as you can see, there was a big gap relative to the Eurozone. Now it's basically closed. which is good news. The other good news is that the labor market has recovered enormously. I mean, unemployment is down to 5.8% now, which is below the minimum reached before the global financial crisis. And labor participation has increased, and employment has increased. So that is probably potential growth, and so that is good news for the future. Now, potential growth. These are the projections in the medium-term fiscal structural plan presented by Italy. And the dotted line is the guidance provided by the Commission, which is pretty similar. There is a very strange bump here, a reverse bump, as you can see. So Italy used to have a pretty low potential growth, so basically close to zero. Then, at least on the projections by the Commission and other international institutions, it went up to 1%. And then it's going down again, oddly enough, and then up again. So I'm not sure this really makes sense, okay? Because it doesn't really match with the demographic changes, doesn't really match with the Next Generation EU scheduled payments or stuff like that. So let me say that if Italy goes back to the kind of patchy performance that we have seen over the past 10 years, meaning close to zero, then there would be fiscal problems. If it is something in the middle, which I think is the most likely outcome, something like 0.5% potential growth, it's okay. It's possible, it's possible to adjust and gradually reduce the debt. If it goes back to 1% potential growth, then most of the fiscal problems would be solved. Okay. Now, let me say a few things about the revenues and expenditures, very briefly. It was a job-rich recovery, as I said, which means a lot of fiscal revenues in terms of social security contributions, which is good news. Again, unless we see the labor market completely reversing, which is unlikely in my view, this is going to stay, which is good news. Okay. Second good news is there is improved compliance, and there is growing evidence. I won't go into the details, but basically the big factor is electronic invoicing. Okay, that is the big factor that improved the situation. And that is probably going to stay. The third factor is that I call it the fiscal consolidation by stealth, meaning that basically the government did the fiscal consolidation without paying the political price for it, because they did nothing. Actually, they cut the tax levels, but the brackets, the bands, tax bands, were not changed. They don't change automatically. And therefore, with higher inflation, there was a lot more taxes to pay. And so there was fiscal consolidation, effectively, okay, without actually paying the political price for that. I mean, the government is claiming they cut taxes. The opposition is saying they increased taxes. They are both right, because one look at the nominal term, the other one the real term. But de facto, the tax increased. And probably this is going to stay. So these are the good news, okay, in terms of the revenue side. The bad news, well, I won't go into that, but you see the red line is social benefits, which 90% of it is pensions. And pensions are linked to the demographic changes, so very unlikely to change over time if there is no measured structural reform. And then there are also some positive news, if you want. These are the interest rate expenditure projected in the medium-term fiscal plan. And as you can see, they are basically growing, both in terms of implicit interest rate and in terms of interest rate expenditure as a percentage of GDP. So I think there is room here for improvement if Italy behaves in fiscal from a fiscal point of view, and spreads keep narrowing. So that's good news. I mean, the bad news on the revenue side is that many of these effects are almost over, okay? So it will be increasingly difficult for the future to improve even more. According to the new fiscal rules, Italy has to increase the net expenditure benchmark by 1.5% of GDP, which means that in real terms, it's a contraction of 0.5 percentage point of GDP. Now, again, over time, this might become difficult without major reforms, major reforms means changing the way Italy delivers services and to the citizens, okay? And so that is the main challenge for the future. So bottom line, as you can see here, the debt, because of the superbonus, is going to stay high, actually go slightly higher over the near term. The deficit will go down quite quickly, and then the debt to GDP will start declining by 1 percentage point in 2028, and then the situation should accelerate, meaning probably more than 2 percentage points by 2030, and so that should really amplify the downturn. But, of course, the fiscal framework is no guarantee that this will happen, okay? It means that you need to have a consistent political commitment to deliver over time to achieve these results. Thank you.
Thank you very much. And to the members of the Parliament, you already received a reader with all the presentations and the position papers from today. So let's go to the next speaker, Ms. Young. And maybe we can switch off. Yes, your turn to speak.
Great. Thank you very much, and good morning, everyone. I think it would be very useful just for me.
Excuse me, Mr. Correndo, can you switch off the speaker? The mic? Yes, thank you.
Great. I think it would be helpful if I just begin how we as a credit rating agency view Spain's credit profile, and then I'll just touch upon elements of the Stability and Growth Pact that are relevant to our assessment of Spain's fiscal and macroeconomic developments. So Fitch, we rate Spain at A-, and we recently placed the rating on a positive outlook. That was back in November of this year, so last month. And the positive outlook very much reflects the improving macro environment that we're seeing in Spain, which is very much underpinned by improving structural trends. In Spain, we've seen a combination of structural reform measures, particularly targeted at the labour market. And when you combine this with the strong population growth trends that we're seeing in Spain, that has also raised our assessment of Spain's medium-term growth potential, which we see to be around 2% over the next few years. And this really stands out when you compare it to some of the larger European countries. So Germany, for example, is a good comparator there. And also in Spain, the economy is going through a positive competitiveness shock. It's lower labour costs and lower energy costs relative to the European average has really helped improve its attractiveness for foreign direct investment. And then at the same time, since 2019, Spain has actually experienced positive growth in its global share of exports, which in some countries there's actually been a decline. And then as a consequence of these positive macroeconomic developments, this very strong nominal GDP growth, this has helped Spain's public debt ratio come down from its pandemic peak, which was around 120% of GDP at the height of the pandemic, but we estimate that to come down to around just over 100% of GDP for this year. Now, the positive outlook that we have on Spain's rating, it means that within a 2-year timeframe, there is certainly a possibility that we could upgrade Spain's rating to a higher rating level, but this would certainly depend on whether some of the positive sensitivities that we have on the rating are met, and these touch upon two key areas, the public finances and the macroeconomic environment. So on the public finances, if we as a credit rating agency are confident that we are seeing a medium-term downward trend in Spain's debt ratio, and I would stress here also underpinned by a sustained and credible fiscal strategy that could lead to a rating upgrade. And then on the macro environment, if we see a continuation of Spain's current favourable growth trends and underpinned also by next generation EU funds, effective absorption of those funds, and also further structural reform, that could also lead to a potential rating upgrade for Spain as well. So now just focusing on the public finances for Spain. As you heard previously, the European Commission has endorsed Spain's medium-term fiscal plan, which will undertake a 7-year adjustment period. And in fact, when you take a look at Spain's medium-term fiscal plan, the government have committed to an average annual adjustment in the structural primary balance more than what is required under the deficit and resilience safeguard of the SGP. And if they achieve this, certainly at the end of their adjustment period, debt would be close to around 90% of GDP. Now, we have our own debt dynamics model, and we make our own assumptions on debt dynamics. We actually see a slower decline in Spain's debt ratio, and this is because that while Spain's medium-term fiscal plan certainly does commit to the fiscal technicalities of the Stability and Growth Pact, the plan itself doesn't really include an indicative fiscal strategy. There are no clear details on fiscal measures that will help achieve those targets. And you may know that currently in Spain, we also don't have any visibility on short-term fiscal measures. We don't have a 2025 budget. And certainly the domestic political environment there complicates and makes it challenging to reach a 25 budget at the moment. Now, just very broadly, Spain's medium-term fiscal plan, just on the expenditure side, the government highlights ongoing spending reviews that are being undertaken by the Independent Fiscal Council. For us, it's very difficult to assess the implications of this on public finances over the medium term, and it's also difficult to see. We don't have any visibility as to whether the government over the medium term would act on these spending reviews as well. On the revenue side, the plan does highlight a quantitative target. The authorities have highlighted that they plan to raise overall government revenue to GDP ratio by 0.4 percentage points by the end of the adjustment period. This itself is not a highly ambitious target, particularly given the fact that when you look at Spain's tax burden as a share of GDP, it is still below the Eurozone average. And for the larger part, when you take a look at Spain's plan, the authorities are very much relying on structural reform to meet its fiscal targets. So they are looking at growth-enhancing measures to broaden its tax base. So, for example, improving human capital, increasing labour market participation, improving the business environment as well. And these structural reforms are already what has been underpinned and highlighted in the government's resilience and recovery plan. The medium-term fiscal plan does add an additional layer of structural reform, and it's very much the authorities targeting new structural issues that will become challenging over the medium term, and that is housing and migration as well. We all know that a key element, of course, of the Stability and Growth Pact is the net expenditure path. And there is a public debate, obviously, that we will probably have, is that how effective this single operational indicator is in balancing economic resilience with debt reduction, particularly for highly indebted countries. Now, in the case of Spain, at least for the first few years, similar to Italy, they will benefit from significant next generation EU funds, almost 5% of their national GDP, so that's about 80 billion euros. Because of these funds, for us, to a degree, the net expenditure path that has been laid out for Spain, we don't see it as a limiting factor for their growth prospects, so long as they can effectively absorb the next generation EU funds. However, this doesn't mean that they should ignore expenditure consolidation. Similar to a lot of other Western European countries, they face increasing expenditure pressures from the need to raise defense spending, aging costs, and also a rising interest payment burden as well. Spain is also targeting primary fiscal surpluses starting from 2026. The last time Spain recorded a primary fiscal surplus was before the financial crisis of 2008. So they would certainly need, beyond structural reform measures, some degree of expenditure consolidation. And maybe just to conclude, I just want to add here that, with the reactivation of the Stability and Growth Pact, you do see that EU fiscal rules are relevant in member states' fiscal policy settings, but it certainly remains uncertain as to how compliant or member states will be, and whether there is a sense of it would impose a sense of urgency for high deficit and high debt countries. And certainly for us as a rating agency, whilst the Stability and Growth Pact is very relevant to our assessment, in that it lays out, gives us insight into member states' fiscal plans, it certainly, we don't have it as a driver for our rating output. And I'll just leave it at that.
Thank you very much. Can you switch off the
Yes.
mic? Yeah, thank you. Then we go to the last speaker, Gemla. Your turn to speak.
Thank you very
Oh,
much.
you have also a presentation? Yes? Okay, then we wait a moment when it's visible. Yes, there we go.
There we go, yes.
Yes.
Do you have the pointer? Yeah.
Thank you very much, Mrs. Chairwoman. Goedemorgen. It's a pleasure to be here and an honor for me and for the company. So I will walk you through this presentation about France's sovereign rating. There has been a lot in the news lately, so I'm happy to comment as well about that. Just let me briefly remind you about the process and the methodology, because I think it's absolutely crucial when we talk about ratings. We have a sovereign methodology, just as Fitch and Standard & Poor's, and of course other credit rating agencies, that relies on a number of factors. And those factors are economic strength, institutions and governance strength, fiscal strength, which is of course the topic of the day, and I will delve into this. But we also have a fourth factor, namely susceptibility to event risk, which looks at the banking sector risk, the political risk in a given country, the liquidity risk, and also the external vulnerability risk. So just wanted to highlight this because, of course, ratings are relatively complex constructs. Just a word about how we come to a conclusion, because I think this is also relevant for this committee, is that we work with a broad set of analysts and also invite other lines of business, so typically the analysts of the banking sector and of course other senior analysts, and we have a practice that is to have twice a year rating committees as per regulation by ESMA. And the ratings are forward-looking assessment on each of the sovereigns. Now, just to give you a flavor about the matrix and how it applies to France, as I said, we have four factors and we combine them together to get to what we call a scorecard indicated outcome, which is a three-notch rating range. In the case of France, as you can see, AA2 to A1, and right now with AA3, the rating sits at the middle of the range. As you can see from the scores, the main credit strength are on the institutions and governance strength. We also score relatively highly economic strength, and then fiscal strength is a credit constraint. I will come back to this. And event risk, I'm also happy to talk about that. But in the interest of time, I will delve into the credit. So In terms of the rating history, France used to be a AAA rated country, lost that status roughly a decade ago and went down to first AA1, then AA2, and just last Friday to AA3. So it's a general but gradual downward drift. The economy, the institutions, and event risk, I'm happy to touch upon that. But again, just to give you a sense about the how we look at the economy. Of course, it's a very large, second largest economy in the euro area, wealthy as well, very well diversified, with some constraints on potential growth, certainly not as good as Spain. But probably not as bad as Germany, so kind of in an intermediary position. I think what stands out in the case of France is the more benign demographic profile, although fertility rates are declining right now in France. On the institutions, here we look at the WGI indicators from the World Bank because they give us an assessment that is valid at the global level. We look at two things here. We look at the quality of institutions. We also look at policy effectiveness. And here we have a clear distinction because on the one hand, we view the institutions are as highly competent and solid. At the same time, policy effectiveness has been weakening, especially on the fiscal policy effectiveness, where we have lowered the scores in October. Again, I'm going very, very quickly to get to the fiscal, but last point on the susceptibility to event risk. We have a max function here, which means that we score all of the sub-factors and we take the worst indicator to come up with the assessment of risk. And as per almost all EU, NATO countries, we have an approach that says that given the geopolitical risk in Europe, given, since 2022 and Russia's invasion of Ukraine, we have scored that at BAA, which is a kind of a standard score for European NATO countries. And I'm also, of course, happy to talk about that later. So let's get to the heart of today's discussion on public finances. First of all, I would like to use this opportunity to do a bit of promotion for the European Fiscal Board because they have a very good fiscal tracker that dates back to 1998, so roughly at the beginning of the euro. And here you have compliance scores with the different criteria. Basically, the greener you get, the better you are in complying with your fiscal commitments, and the darker, let's say, orange and red, the worse. And as you can see, I think it's quite explicit from this slide. France has a poor track record, but also the worst in the EU 27, right? So I think it also speaks to continued weakness in terms of public finances management. Now, looking at the two, let's say, components of our fiscal analysis, we have the debt burden analysis, so, debt to GDP, debt sustainability, and we have also debt affordability, which is basically the cost of carrying debt. As you can see from the chart on the right-hand side, where we have listed all AAA and AA rated countries, well, France's debt burden is the highest in that category, which gives you a sense also about the importance of the challenge. Our current forecast is that debt to GDP will continue to increase from roughly 113% this year to almost 120% in 2027. I mean, this is a simple mathematical problem given the size of the debt and the growth of the economy. As long as France doesn't have a deficit of around 3%, then the debt continues to increase. On the consolidation going forward, so what drove the rating downgrade of last Friday? Well, it's basically that when we moved the outlook to negative in October of this year, we had the expectation that the 2025 budget would be adopted with the beginning of fiscal consolidation. Now, of course, given the political situation and the fact that the government fell, we believe that now consolidation will be even more difficult in the coming years. And so we have a fiscal deficit projection of around 6% next year and then gradually declining in 2026. Now, as you can see from the chart, there is a structural difference between expenditure and revenue because revenues in France are quite high already. And I think it's a major difference to, for instance, Italy and especially Spain. But spending is even higher, right? And there is, I would say, a very large consensus that is quite difficult to cut spending. Now, also coming back to the presentation that was given by the Director General a few minutes ago, you can see here on the right-hand side the green, which is the net nationally financed primary expenditure path that was submitted in the medium-term fiscal structural plan, and in blue, the Commission's reference. As you can see, there was a pretty ambitious objective in 2025 of 0% growth. That was, of course, before the fact that the government was dismissed. So we have serious doubts about this being fulfilled this year and also in the coming years because this was a relatively front-loaded plan. In terms of debt affordability, as you can see here again, France comparing to European countries, some in the AA camp, some in the A and even BAA in the case of Spain. You can see the debt affordability metrics, so the cost of debt vis-à-vis revenues or vis-à-vis GDP is increasing quite significantly. Of course, France has a relatively high average maturity of 8.5 years. But of course, given the relatively high refinancing needs, higher deficit, higher debt load, you can never exclude a negative feedback loop there, and so debt affordability eroding in the future. This is a very also detailed table, just to give you a sense about, because this is typically something we discuss in rating committees, is France vis-à-vis other peers at the AA3 rating level. But in the interest of time, I will leave it there. Thank you, Zeer.
Thank you very much. Then we go through the round with the questions. We do it one question and you can right away answer, not like we did this. And I will ask the members of parliament to address to which expert you ask the question. And I will start with Aukje de Vries from the People's Party Freedom and Democracy.
Thank you. Thank you so much for your presentations. I have a question about France, because you downgraded France last Friday. Is that primarily because of the political situation? And I think that if you downgrade a country like France, then you're not very confident that they will implement the plans they used to have for the future. And what are the consequences for the interest rates for France for the future with a downgrade? Thank you.
Ms. Remla.
Thank you very much for the question. I mean, as we stated in the press release, it's really about the policy impasse that results from the political situation, right? So, of course, when we look at a sovereign, we always are interested in policies, not the politics, but really policies. And here, what we see is a very fragmented parliament. You have basically three blocks, and unlike in other countries, such as, for instance, in the Netherlands, there is no culture of compromise and coalitions in France because the system was built by General de Gaulle for, in a very different construct. And so this is what gives us, raises question marks about the willingness and the ability of the next government to reduce deficits. Now, there is the European fiscal anchor, and I think it's an important one. But again, as we have seen in the past, this has not prevented repeated fiscal slippages. So in the current environment, I understand that there still is, from a large part, of the authorities, especially at the finance ministry level, the ambition to start the consolidation, but we will need to see concrete measures, concrete projects being put forward. What we saw during the first phase of the parliamentary debates were kind of inconsistent approaches, with some arguing for very large tax increases. Then those measures were voted down. There was not really a serious discussion about expenditure restraint. And then at some point, there were some concessions that were granted by the former prime minister to some political parties to try and get their support. Didn't materialize. So we expect that, well, first of all, I didn't mention this, but there is no risk of shutdown in France. A special law has been voted by the National Assembly, so the lights will remain on. That's not an issue. But that doesn't mean that there will be fiscal consolidation, because that's the second part, if I may say, and that will come probably around January or February. Now, your question about interest costs, I mean, of course, it's a market reaction. What we've seen is still relatively benign cost. I mean, the spread has widened compared to July, when President Macron called for snap elections. So that spread is going to be a bit higher for longer, but it's still relatively contained, also based on the fact that there is this anchor.
Thank you. Then we go to Heer De Vree from Party of Freedom.
Thank you. Thank you for telling us something about 4 important European countries, about Germany and France. When I hear what you tell us, the US expression, Houston, we have a problem, pops up. Can you tell us something about possible consequences of the situation in both countries for both the Netherlands and the EU?
For which is this question?
Pardon? For both France and Germany.
And Germany, okay, both. We will start with Germany. So,
thank you for your question. There is no doubt that Germany is by far still the most important trading country of this country. 23% of Dutch exports go to Germany. And there are many, many very refined industrial linkages in the value chains of suppliers in especially the eastern part of the Netherlands, but all across the Netherlands, supplying into Germany's industry and vice versa, let alone the ports in Rotterdam, etc., that supply. So Germany's industrial malaise is very relevant, I think, for the Netherlands. I would see the change in fiscal policy that is now probably going to happen in Germany. It's not a guarantee. But if they reform the debt brake, and if the additional spending that a new German government will do is relatively well targeted on the public investment, on the infrastructure, on the domestic drivers of growth that Germany so badly needs, I would see that as very positive for the Netherlands. I would also see it as quite positive for the rest of Europe, in the sense that Germany has probably underspent a bit too long, and it's also spent too much or too little on investment. And so there'll be some positive spillovers, growth spillovers, even for France and other countries, limited, but still. And I think it opens up a more useful debate at the European level of, in a hopeful world where France consolidates a little bit and Germany loosens a bit. But, none of that's guaranteed. The major factor that's in the room is, will the parties that have endorsed a reform of the debt brake, will they get a 2/3 majority required to make the constitutional change? That is not guaranteed, and so that's an important question mark. And then there's also a question mark, will the reform, as an economist, I worry about this, will it only be for defense, or will it also be about the long-term competitiveness of the German economy? and that too is not settled. The common denominator is that there should be a defense fund for after 2028 when this current one runs out. But from an economic perspective and from a potential growth perspective to comply with the SGP, let alone also aging costs, which are significant in Germany, we do really need some reforms and we need a reprioritization of investment. And so these are the kind of questions I think that will matter for this country and the rest of Europe.
Thank you. Then we go to France, Mr. Gimla.
Thank you very much. Just perhaps one quick point I didn't made previously, but compared to some of my colleagues here, we cannot make any policy recommendation. I think it's very important to state it, because by regulation we are strictly prohibited. So I cannot say if this is good or this is bad. Just as a first point. Then the impact of the French situation on the Netherlands and Europe. I think the transmission channel is probably slightly different, because the French economy actually is still holding up quite well. It's not spectacular, but it's quite resilient. So the channel would be more about the impact about, potentially financial markets, financial stability. Clearly, we're not seeing this right now. What we're seeing is a quite idiosyncratic type of development that is, really related to one situation in France that is very well, I would say, identified by actors. So, of course, if you were to see slower growth in France and assuming that Germany does not recover, then, of course, that would be a global problem for the euro area economy, right? But I think the transmission channel is probably slightly different.
Thank you. Then we go to the Green Pact and Party of Labour, Heer van der Lee.
In English, we say the Green Labour Alliance. So, thanks very much for the interesting presentations, and I also read the documents already. So I have a very specific question related on the investment gap in Germany. Is it the 600 billion? Is it public spending or public and private combined? And what's the time frame beneath the gap? And how does this link to, say, the 800 billion spending gap? You can call it, Draghi has highlighted. And I have a second, more general question related to all four countries. What would the impact be on, so let's say, a strong implementation of Draghi's report on the fiscal situation of each of the countries? Given the fact that some of them already benefit very much from Next Generation and the recovery and resilience, would it add, or is there a lack of absorption capability, and how does this plays out in the different countries?
Thank you. Je had in Duitsland gesteld? Of, ja. Okay. All four. So. Okay. Then we start with Germany.
I do think we live in different times when Germany is one of the more interesting countries budget-wise in Europe. So on your question on public investment, so the 600 billion, it's one estimate. The German Industrial Federation estimates it at 450. Some of the banks at 600. I think it's somewhere in that order of magnitude. That's the public investment gap. So that is essentially the accumulated loss of the public capital stock, if you will, of having not prioritized investment for 2 decades, essentially. And so, the question is, how does that relate to private investment, which is the ultimate driver of innovation and growth? What you see in the German economy is that private investment is also pretty depressed. And it used to be that private investment in Germany had a very strong correlation with exports. Again, this industrial sector was the kind of beating heart of the German economy, and when exports were doing well, firms would invest. That correlation has broken down because of the problems in global markets for German exporters. And so my hope is that if the public investment side steps in, that you get a bit of a recovery also in confidence on the business side, which would prop up demand and prop up private investment a bit. How it relates to the Draghi estimate, I think, was 80% private, 20% public of the 800. I certainly have not. I don't think anybody's compared those two numbers specifically, but it fits into the same logic. And so, yeah.
Thank you. Then we go to Italy.
Very briefly on the question on the Draghi report. I mean, my taking is that the need for investment is not the main message of the Draghi report. Okay, Draghi actually says how to improve competitiveness and improve growth over the long run, which would enable also, to attract the private investment and have big chunk of the investment need covered by the private sector rather than the public sector. However, given the experience of Next Generation EU, which was supposed to link supply and demand, because it's a stimulus to demand, but at the same time, given it is investment, is also improving the supply side of the economy over the long run. I would say don't expect the investment plan to brought immediate effects. I think it would not even be desirable in my view, because again it messes up the allocation of resources within the economy. So the best idea would be to have a long-term plan which can inform expectations in the economy on the private side, and therefore stimulate the domestic demand in various countries from the private side, not the public side, and that could also support. So you again go gradual, go long term, and have set clear objectives so that they can guide the private side of the economy. That's the message in my view.
Thank you. Then we go to Spain. Ms. Young.
Thank you. Of course, more investment is always very good and positive for our economy. I think I would say here it very much depends, as you mentioned, the capacity of a government to absorb these types of funds from the EU. In the case of Spain, there needs to be still a lot to be done in terms of structural reform. And the question is, even though when you have a lot of investment funds coming in and there are plans by the government, how effectively is it penetrating the private sector? And each member state is very heterogeneous in their structure of their economy, structure of their private sector. In the case of Spain, they will still need to implement structural reforms, still bringing down high structural unemployment in the economy. They need to improve, certainly, bureaucratic tape, which perhaps hinders private sector investment and housing reform as well. And at the same time, it just very much depends on individual countries and how they would implement the reform, the structure of the economy, and how effective they will absorb those types of funds. But always, more investment is always good.
Thank you. Then we go to France. Gemla.
Yeah, I mean, I echo what was said about absorption capacity, because it's really the key. I think the last point I would make is, reallocating spending between the national and the supranational level, right? So, of course, you take some pressure off national balance sheets, and you shift it to the supra. But of course, then that comes with other types of risks, and so it would need to be really, I would say, very well defined. And there are some usual suspects projects. I mean, one was mentioned, defense. But there are other public goods that could fall in that category.
Thank you. Then I see we have time for another round questions. So, I'm so sorry. The best one. Then we go to the last question from the first round from the new social contracts. Hitsinga.
Yes, thank you very much, Madam Chair, and thank you all for your interesting contributions this morning. I had a question, and I think it's best addressed mainly to Mr. Todouar and Mr. Codogno, and that is about a trade war. This morning, when I was in my car driving to the office, as you call it, I heard that there are large concerns, especially, for example, in Canada, due to the fact that Mr. Trump has announced that a couple of times that he is very much in favor of raising tariffs. Well, especially to the German economy, this could have a major impact, being one of our backbone economies in Europe, which also might impact the Netherlands as well as other countries with an open economy. What, in your view, is our best response? Question mark.
You can answer.
The big 60% tariff question, I guess, in the room. So, one analytical observation. One of the interesting changes in the last 2 or 3 years has been on the German side, that given that trade markets clear globally, that as they've lost access to China and as China basically replicates what Germany provides them with their own domestic production, the US has become much more important for Germany as the market for end demand. Germany's largest trading partner is in fact now the US. It overtook China a year ago. And so, you know, there's clearly a risk from the tariffs. But one of the interesting things to watch is, will Trump be tougher on China than he is on the EU? He's upset with both Europe and China for having a trade surplus with the US. Bilateral trade surpluses are not necessarily the best indicator, but he cares, right? He cares, so he's going to do something about it. But if it's, you know, a much higher tariff rate on China than it is on European exports, then given that the US still cannot necessarily provide all the demand itself, it could even be net beneficial for some German exporters, because it'll be harder for Chinese firms to supply the US market. That leaves opportunities for Germany even at a higher price because of the tariff. So I think that's an interesting dynamic to watch. The general response, I think, as Commission President von der Leyen has started it, is probably our best bet. So you commit to buying more American LNG. You commit to buy more American weapons, which to an extent we need anyway, because we don't have the military industrial capacity in Europe to scale up quickly enough. We need the gas also to an extent anyway. So you can make these kind of commitments to try to basically cool down the tension. I do think the Trump administration will hit some key European exports, in particular cars, as a retribution for our digital services taxes. But that may be a relatively constrained trade spat that doesn't explode into a wider trade war. So I think that's probably the way to do it, and then hopefully there's some scope for deal making. One other interesting thing is that because of Ireland's tax practices, our trade surplus with the US looks a lot bigger than it really is. A lot of it's also American firms that have intellectual property nested in Ireland, which then, you know, are counted as exports, basically medication or iPhones sold in the US. Some of it is counted as basically European exports to the US because of Irish practices. So I don't think politically we can change that, but it will probably be the most helpful.
Thank you.
Yeah, thank you. I fully agree, by the way. So I think the best response would be to commit to import from the US what Europe would import anyway. Okay, first. Secondly, and I think it's already happening, by the way, because as you know, the Commission has already a task force, set a task force to kind of not only to prepare, but also to signal to the US that we are prepared. Okay, and by the way, I was in China very recently, and I think China is doing mostly the same, which is targeting specific sectors which are politically sensitive. Okay, so basically what you do is you target the midterm elections, the next midterm elections, and what are the electors that would be affected the most? Well, basically, Midwest crop producers, or whatever, and that's the way to do, because we know from economics that protection is pretty bad for the economy. We know that if we start a trade war, it would be pretty bad for Europe as well. China knows that as well. And so what you want to do is to do limited things, which gives the political signal that we are doing something, and achieve the maximum political impact, but the least economic impact, possibly.
Okay, thank you. Then we have time for another round, so Aukje de Vries.
Thank you. Perhaps go a little bit back to the Stability and Growth Pact. I have a question about the Stability and Growth Pact, because there's a lot of worry. We're worrying about the countries that you were talking about, and it's not least countries in Europe and the Eurozone. We've seen what kind of problems there were when Greece got into big problems. But does the Stability and Growth Pact does it has the right stimulus to implement the needed structural reforms that are necessary for the countries to restore to a better financial situation? And I don't know who can answer the question, but
we will see who answers. Cologne.
Okay. Let's say the short answer is no, okay? Because at the end of the day, you need to have a political will. As a disclaimer, let me say that I'm not a great fan of Italy's prime minister, okay? But I think the government is reasonably fiscally responsible, the current government. On the reform, the jury is still out. Because I think if you listen to Italian media these days, they talk about reforms, and there are three reforms. One is institutional reform, basically giving the prime minister, having the prime minister elected by the people, and having an institutional reform. I won't go into the details. Secondly is the devolution of the country, so basically giving more responsibility and third is the judicial system, so basically separating the role of the public prosecutor from the judges. Okay, so if you look at the reforms required by the Next Generation EU, these are not in, or at least they have a small part of it. Okay, so you wonder. I don't have a clear answer. You wonder whether this is a political way to deflect the attention of public opinion from the real stuff, because the real stuff would be politically sensitive. And the reforms attach significant political interest and political opposition and so forth, while still doing things behind the scenes, which would be the good way of thinking. And maybe it's happening, okay? Maybe it's happening. The problem is that it's too detailed, too granular, and it's difficult to monitor and to follow. The other option is that the government simply doesn't care, and they have a different political objective. Again, the good interpretation is that, as in many countries, in Italy, but as in many other countries, the political discourse is completely disconnected from the economic reality, meaning that the government is concerned about maintaining political consensus, and doesn't have a strong ideology or a strong opinion what needs to be done on the economic side, which sometimes could be good, because it means that they allow the experts to do what is necessary, okay, and without, say, the media attention, okay. And again, I'm not saying that this is not happening. Maybe it's happening. Maybe it's happening, which it would be good. That's my answer.
Thank you. Mr. I'm sorry.
Thank you very much. Yeah, no, just to react, I mean, two quick points. I would say ownership and willingness, right? You need ownership, and certainly there progress needs to be made. And then willingness is really to tie domestic policies to European commitments. And that was, one of the missing links under the previous architecture, and it remains to be seen whether that will be the case with the new one.
Okay, thank you. Mr. De Vree, your next question.
Thank you. My second question is for Italy, and I think it's a bit nasty. In one of the sheets, you mentioned a longer planning period. Isn't that something we have heard from Italy in an earlier stage and in some earlier stages? You mentioned a longer planning horizon, sorry. Can you tell us about mentioning again a longer planning horizon?
I'm not sure I got it right. So
Okay.
basically you're saying Italy is postponing basically the adjustment again.
I think Italy's rather famous for a longer planning horizon, and we see it again in this sheet. Can you tell us something about why you need, again, a longer planning horizon?
I mean, my personal perception is that the adjustment process needs to be stricter, okay, and needs to be implemented fully, but needs to be reasonable, okay. Let's face it, the previous debt rule was not feasible for Italy. And so you need to design something which is feasible. I think the current plan, following the guideline provided by the Commission, but also then translated into the national medium-term fiscal structure plan, is reasonable. And it is ambitious because it means, basically, as I mentioned, it means effectively reducing, in real terms, net expenditures by 0.5 percentage point per year, which is quite a lot. Now, because of the super bonus, the debt to GDP will go higher over the next few years. There's nothing you can do about it, okay? That's a given. Now, what matters is to set in motion a debt dynamics that gradually takes over and then push the debt ratio down. And that is happening with the plan. If it is fully implemented, it is actually what is happening. So again, I think 0.5 percentage point contraction in net expenditure per year is ambitious and it is feasible, in my view.
Thank you. Then, Mr. van der Lee, your question?
Yeah, I'm not sure who can answer this one, but you can decide yourselves. But this morning in the first presentation, I also asked a question about the new SGP. Some of you have already mentioned there are some improvements in it, but it will face a litmus test, probably specifically around France. What would be the impact if the test's results are negative, in the sense that the system is not working to convince France to do what is necessary and agreed upon? What would be the impact?
I will see who wants the question. Yes?
I can say a few things in German.
Okay, from Germany and maybe later on for Spain. Yes? Tudor.
Yeah, on the German case, so we want to avoid, ideally, that our two sinners are immediately the two largest member states, like we had at the beginning. So this is, I think, the spirit of your question, and I fully agree. So in the German case, I do think the new SGP, it has improvements, it has some flaws, and in the German case, those will come out. So one is that the reference trajectories in the DSA don't really, and so the spending path that comes out doesn't really take into account reforms and investment and their impact on potential growth. And that matters a lot for Germany, because they need to make the investments. I think there's a real commitment to do reforms in Germany as well. I'm quite optimistic about that. And so I think it's critical that Brussels, Council and Commission find all the space they can to essentially reward Germany for embarking on an ambitious reform and investment program, and not to be too much of a very narrow-minded accountant who says, but in our DSA, that's not actually allowed. So I think this will be one important litmus test for the legitimacy of the rules, essentially. Related to that, and I'll pass over the French question, but on the French side, it's more or less the opposite problem, right? And so.
Thank you. Yeah, you want also to reflect on the question.
Sure.
Please.
Thank you very much. I think the transmission channel would certainly be via higher interest costs. I think it would be the channel I see is because at some point you have an even higher repricing of French risk. I mean, we have seen that starting to some extent since the snap elections. But of course, this could continue. So at some point, and there are debates currently in France about the size of the interest burden, and some comparing those expenditures to the size of the, for instance, education ministry. So typically next year, in nominal terms, I'm speaking, the size of the interest payment will be higher to the spending on education. And I think everyone agrees in France, like in many other countries, that education spending is the future. So that could also be, a trigger for, if we are a bit more optimistic for some reforms.
Thank you. Then we go for reflect from Mr. Codogno.
Very briefly, two points, one positive, one negative. Okay, the positive one is that the projections embedded into the medium-term fiscal structure plans are very conservative right now. Okay, just to give you, I won't go into the very technical details, but there is one example. The multiplier of expenditure cuts is 0.75. Which means that if you cut 1 percentage point of GDP, you get 0.75 less GDP growth. Now, people know that sometimes if you cut, it's 1-to-1 to GDP, because if you cut, it goes directly into GDP. However, people forget that there is what is called in economics general equilibrium effect. Okay, so basically, if you cut, you have positive effects in the other parts of the economy. So effective 0.75 is very conservative. So means that we could have positive surprises, and that could actually support the framework, because after 2 or 3 years you get positive surprises, and countries deliver because they are built on conservative assumptions. That is the positive news. The negative is that I fully agree that the risk comes from interest rates, and unfortunately we have kind of introduced a surrogate, say, lenders of last resort functions in the Eurozone, but there's still no full. I mean, in the UK, as you know, Liz Truss introduced a budget, and it was a completely misguided budget. Financial market got crazy, and then the Bank of England immediately intervened. Okay, and that was pretty much effective. Stopped any. If you want my feeling, we have the TPI in the Eurozone, but it won't happen as quickly, and it will go through a bit of process, let's say, and that might result into stress and contagion. That's the risk.
Thank you. When you can switch off your mic, we go to the last question from Mr. Itziger.
Yes, thank you. I have a very detailed question regarding Italy. Because I saw in your presentation, Mr. Codogno, that there was a spectacular result in increase of government income due to electronic invoicing. What is your underlying analysis of that spectacular increase? Does that mean, in other words, to put it to be a bit dodgy, that it has helped to reduce the black economy? Or is that statement too premature? That's question 1A. Question 1B is, what could other countries learn from this experience? Thank you.
Mr. Codogno.
Thank you. There is actually a detailed analysis done by the Italian Ministry of Economy and Finance in the plan. Okay, there's detail. There's 2 or 3 pages, and then there is a paper, supporting paper, that estimates what is to be considered as a permanent effect. Okay, because we have seen an increase in fiscal revenues, but we don't know whether it is permanent or not permanent. And the result is that a big chunk is permanent, especially on VAT. That has been particularly effective, because electronic invoicing started before the pandemic, okay, and gradually took off. effectively companies have no choice. I mean, they cannot escape. Okay, so that's why there is more kind of compliance right now. The message is that electronic invoicing is the way to go. Okay, because that eliminates the possibility of escaping. And then there is also improved compliance on direct taxes for a number of different reasons. So the overall, tax evasion in Italy is still pretty high. It is estimated around 100 billion. Okay, so big chunk. It's 5% of GDP. But apparently has been reduced over the past 5 years about 1/5, meaning 20 billion reduction. Which, given that it was done in a period of crisis, that is particularly significant because it's cyclical. Usually it's cyclical. When you have a downturn in the economy, it increases, okay? And so I think it's pretty encouraging.
Is it enough, so the answer?
Yeah, well, I think also my question was my second question. What could other countries learn from this experience? Would it work also because electronic invoicing is not obliged everywhere, right? It's in a number of countries. Do you think that the results would be the same if we would apply this also in other countries, for example, the Netherlands?
Yeah, I don't know the situation in the Netherlands, to be quite honest, but I think Italy, among the European countries, Italy probably had the highest tax evasion, or one of the highest, on VAT. And VAT, electronic invoicing is pretty effective in my view. So it's compulsory for the public administration. It's gradually used also in the private sector, and if it becomes compulsory, I think everywhere it would eliminate a lot of the problems. That's my taking, but again, I'm not fully an expert on VAT stuff.
Okay, thank you. Thank you again for stepping into the Netherlands and to share all the information with us. And the time is it's almost time, so we wish you a safe journey home, and I will close the meeting. Have a nice day. Yes.